Okay, thanks for that. Well, let's also get a handle on what's happening, in several pockets and how you should be approaching it. David Lennox, the analyst at Fat Profits, joins us now to talk about that. David, good morning and thanks for joining in. There are, of course, demand concerns with respect to crude, right? So we've seen a fall to about $80 a barrel. Now there's a bit of a recovery that has come through. But what's the sense you're getting about which way crude could head? And in the very near term, what are the markers, both the floor and the ceiling for crude prices?
Look, certainly, yeah, we have seen demand being somewhat destroyed by the fears that the world is going to go into a recession, and really that's what's driven the oil prices down to where we've seen them currently. As we start to get used to the fact that perhaps there is going to be some form of recession or some form of slowdown that's going to occur, we have started to see member countries in OPEC and Russia are particularly popping up and suggesting that they're going to be quite comfortable in terms of cutting back production, and we would expect to see that same sort of rhetoric coming out of other OPEC members as well. So look, overall, it certainly has been the fear that we've seen with rising interest rates in the US that we're going to see a hard landing or even in fact a recession created, and that's what's driven the oil prices lower. Look, until such time as we can see the Federal Reserve indicating that they're going to pivot away from a hawkish stance, and there's certainly no sign of that at the moment. They've been really quite stern on continuing to lift rates. Until we can see that starting to come through, that change, I think the oil price is certainly going to struggle as to where it is at the moment. As any whiff at all that we're going to see a slowdown, we'll see demand destruction, and we've seen what that does to the oil price. In terms of setting prices, it's a bit of an awkward market at the moment. Prices have been all over the place, but generally to the downside. We are expecting in the short term perhaps to see a little bit further strength in the US dollar. If that's the case, then one would expect to see a corresponding weakness across the broader commodity space. So perhaps the oil price, Brent especially, testing back towards that $80 region wouldn't be out of the question in the short term. Over the longer term, we have got a more positive view, but you really do have to probably look beyond the end of this year to see that view coming into play, and we would be suggesting that the oil price would be able to retest $90 to $95, certainly early in 2024.
All right. Hi, David. Good morning. So, giving us a broad range near-term 80, and maybe, in the months to come, maybe we go back towards that $90+ dollars or barrel. But I'm more interested in the downside. I recall you had given us a broad range of 70 to around $100 odd. On the downside, where do you see it headed?
Look, as I say, if we do see any real sign that the US economy especially is slowing down significantly, and that's what the interest rate rises are designed to do, then that's going to cause the oil markets to really implode probably, and certainly get back towards that $70 region, which we've talked about. There's no doubt that we can see that coming if the market continues to deteriorate on the economic front. There is a counter to that, and that's been China. We have seen China now obviously moving towards a more normal COVID economy, and that's given some flip to the demand side, but it certainly is the supply side that's going to be the governing director of where prices are going. If we see cuts coming out of OPEC because they're concerned about where that price is or how low it is, then that's going to help lift the oil price. But conversely, if we see the oil price starting to really rise, then we're going to see fresh production coming on stream. So look, overall, I wouldn't want to be an oil analyst at the moment. I think the prices are really quite volatile.
Okay, so let's go then according to what you'll be more comfortable on. What about iron ore and steel prices? Because of the China reopening and fears that there's going to be some bit of a shortage of supply, maybe from Brazil or even from Australia, iron ore prices have moved up quite well, and steel prices, I think it's clocking more than $650 HRC. Where do you see both those two? Give us a couple of levels.
Oh, look, certainly both steel and iron ore are going to improve going forward, and that is on the back of the China story. As we get further and further away or more normal into the Chinese economy operating, then we are going to see a recovery in those prices, and that's really what we've seen happening. iron ore has been able to, over the course of the last probably 12 months, sustain some fairly bad news in terms of economic data and certainly China. And it hasn't really capitulated in any significant way. So that would suggest to us that there is underlying strength in the market, and that underlying strength is keeping those iron ore prices now well away from the $100 where we had seen it trading. So if that's the case, then we would expect we see more and more time pass and China becoming, let's say, more and more normal under COVID rules like the rest of us, then we would expect to see those iron ore prices continue to just firm up. But we wouldn't be banking our houses on it or putting our houses on it, because there just doesn't seem to be enough strong momentum to push the iron ore price, say, towards $130 to $135 at the moment.
All right, David, thanks so much for stopping by, giving us your view on crude oil, which is a little bit tricky, and also your view on iron ore as well as steel prices. Appreciate you joining in. Well, let's go back to Gurmeet Chadha.